Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, sitting next to Geoff Gannon. Jeff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else as well. If you're watching on YouTube, hit that subscribe button. If you are listening on the podcast side of things, hit that subscribe button. Love all of the support. It means a lot to Jeff and myself. Today's podcast, we are going to be doing a Q&A. I sent out a call for questions, and we have a bunch of different questions to go through. This is going to be a two-part series. We're going to cut this off at 25 minutes, and then we'll do another one, which will go up next week. I'm going to do my best to read the screen because I don't have my glasses, and Jeff's like, can you read it? Because I don't have my glasses either. So we're basically kind of both blind. So we're going to do our best right now. But if you want to be on the lookout for Q&As in the future, you can follow me at Focus Compound on Twitter. So the first question says, I heard someone say the other day, might have been you, that they don't think investors should measure themselves against a benchmark. We actually just did a podcast on this.
Yeah.
Although this may help with questioning one's utility in the world, isn't this ignoring basic fundamentals of investing? A bird in a hand. So we could start with that for now.
Yeah. In the long run, it matters. In the short run, it doesn't matter. We did a whole episode about it.
And then he says, how have you measured your performance? Over what time period do you measure? Buffett says a rolling 5 years. How do you think about beating the market?
Phil Fisher said you always hold the stock for 3 years before he made a decision about it, just because the stock went up or didn't go up or something like that. Buffett's talked about 5 years. I've looked at my performance both versus the S&P 500 and not. I will say that in my case, since I've been investing in the late 90s to today, the correlation with the S&P 500 is low. So my absolute performance would be remarkably stable when measured over like 5-year periods and stuff. Whereas versus the S&P, it'd be wildly swinging all over the place, weirdly. So, if you didn't know what the S&P 500 was, you would think the performance was remarkably stable over a long period of time. It's debatable which of those matters more. Obviously, depending on how high your correlation is. And I actually did a whole study of what my correlation was and stuff for something we never used. But it was very, very low.
I literally cannot read my screen right now. Okay. Last time you said great investors ignore price, but without control, you profit from only dividends and appreciation.
Right.
How can you ignore price when that's half of the return formula? Private owners can ignore price because they control cash flows. Ignoring price seems like a luxury. That's a good question.
I think so. There are cases in which I'd be careful if you don't like who's running the company and they have ways to protect themselves that you shouldn't, that you should not, that you need to pay attention to price. However, in the case of companies that can't protect themselves from raiders and stuff, then actually, basically it will be realized by someone else and you don't need to do it. I do agree that insiders and outsiders had different things in terms of control stuff. So an insider who controls a company can always sell their whole company out and doesn't need to care about price at all. But generally it has been my experience that buying things just when they're incredibly cheap versus their value to a private owner vastly outperforms the market. The only exception would be things run by crooks, people who don't want to ever have it fall out of family control, whatever, who also have strong means of actually protecting themselves. There's multiple shares of voting classes. There's ability to put in a poison pill, things like that. And we do sometimes avoid some stuff like that. There's stuff that I won't get into it, but there's like closed-end funds I'd be happy to buy. If we could get control of them, we would. But there's reasons why I don't think we could have control of them. So without control, I wouldn't buy them. But that's an example of like the people running it are so deficient in the way that they run things and stuff that they can always liquidate it at a fair value, but outsiders can't. But those are just a small part of how the world normally works.
Yeah, and there's been a couple of situations where we're like, normally we're constrained by AUM, and we're like, we wish we had more AUM because it would make us feel more comfortable in this investment.
Sure. And I also point out that things like people would said that I started buying bank insurance before there was an offer for it to be bought out. And people would say, well, why would it ever go up? Insurance companies always trade below book. Sure, it's better than most, but now it's not listed or anything. Nothing will happen. Well, there was an offer to buy it out. People thought Vulcan would never liquidate, did. I wrote about Paradise before, and people were always worried that Paradise, nothing would happen. The people got old enough, they wanted out of the business. And what did? They liquidated it. So they actually sold it. But
recently, right?
Yeah. But so in all those cases, you'd be surprised. Things do happen. If you go through Value Investors Club and look up things of where they say nothing will ever happen with this, you'd be surprised. Sometimes it does, sometimes it doesn't. But even if on average they take 10 years, that would still mean there's a 1 in 10 chance that it'll happen this year, which, when averaged out, if it's a 100% upside with a 1 in 10 chance of happening this year, Wow, that's a huge margin, you know?
You just make so much sense sometimes. How exposed? I was thinking about this yesterday.
Okay.
And this is my first question, actually, when I talked to Geoff today.
All right.
And I was just telling him, I was thinking through every one of our companies. I was like, okay. How exposed are banks to writing on or near commercial property that may own mortgages on? Cash Hack Geoff mentioned he has more experience in banks that focus on commercial lending, I believe.
Right. I do more on companies that have commercial lending and generally less on companies that have finished properties that they continue to use and occupy. So generally, the only banks that I invest in and analyze and stuff would tend to be things that are like building an additional property or things like that, more so, not so much holding it for investment reasons. I don't know all the details of that, but in general, just so people know, most businesses, the way they work, are incredibly better protected against rioting from an insurance perspective than against pandemics. Buffett talked a little bit about the pandemic stuff, but I've read a lot of things where it talks about insurers being negatively affected by pandemics. I mean, business interruption stuff, generally the standard stuff does not cover anything having to do with pandemics. Your building being set on fire or fire spreading from other things and stuff is a very normal insurance policy to have. Very normal. In fact, there'll be a great deal of fraud presumably with this. That will be one issue. There are certain towns, I mean, I'm from New Jersey originally, so I know what some of those towns might be and stuff, where some owners, because of coronavirus, were already having problems. I mean, I can look around here and see that 2 or 3 restaurants that I like are gone forever now. They've closed down forever because of coronavirus, not because of rioting. If there's rioting stuff near them, there's an incentive for the owners to burn down their own stuff, and there will be some of that.
Yeah. Thoughts on valuation modeling overkill? Watched Pershing Square Challenge, Columbia Business School, beautiful presentations, etc. for a small profit, or Bill Ackman's 3-hour ADP presentation versus someone like Joel Greenblatt, Norbert Liu, who can lay out clear, concise investment on one page. I have a thought on this, but you go first.
I mean, from our own personal use, my preference would be to spend like hundreds of hours studying a stock to get the kind of information that you can boil down to a paragraph. That's what I care about. It's really the degree of confidence that I have of their position in the industry and things like that. So I may say something to you like that I think that Progressive is the best underwriter in auto insurance. I would like to spend days learning that and then just have that belief firmly based on that and not need to know much more than that. So I just think, on the other hand, complexity sells in presenting to other people, and it often gives a perception of you that's more positive.
My thoughts on it would be, I mean, Bill Ackman, he's an activist investor, and usually they try to change stuff within the business, where Norbert Liu and Joel Greenblatt's more probably like us, more on the passive side of things.
Right.
So, I mean, of course, if you're going to run a proxy contest or try to effectuate change within the business, you're going to lay out a presentation that shows everything that you would want to change, whether that's cutting costs, replacing management, et cetera, doing everything like that. So I think that's probably, there's a difference between what Bill Ackman's trying to do normally and what Joel Greenblatt would have done or what Norbert Liu is trying to do as well. We'll
see. Maybe I'll regret these words, but my guess would be if we ever do a proxy campaign thing, it'll be on one sheet of paper.
We'll see. Have you ever looked into, is that Bolloré? I don't know what's...
the French company?
Yeah.
Is it B-O-L-O-R-E?
Yeah.
Yeah.
Story at all? If so, what are your thoughts? And then what is your go-to karaoke song?
I don't have a go-to karaoke song.
Don't Stop Believing. It's not everyone's favorite karaoke song. Something like that. Journey.
So
I could so see you screaming it into the microphone. No?
Yeah. So it's a complex situation. It reminds me a little bit of Big Larry Holdings stuff. There's some complexity that has to do with other countries and stuff in Africa and some things like that. But overall, it's something that people should study up on, and it has a complex thing where things that it owns part of it and stuff, and that's a structure that you'll see from time to time. It's more common in European countries than the U.S.
Should R&D expenses be capitalized?
Phil Fisher wrote about this and stuff. Some R&D is a total waste, and some R&D is very effective. It's hard to tell which is which. I once researched pharmaceutical companies and decided to buy instead a company that just does testing on blood and urine, because I had no idea if the R&D that they were doing would pay off in the long run. So for things like that, I would say no, R&D, we don't know is the answer, but you should analyze and try to see if they're getting a good return on their investment. I would say that if I like their R&D and stuff, then I'll give them a lot of credit for it. But in general, I would expense it, I guess. Yeah.
Buffett paid 41 times after tax for Nebraska Furniture Mart. So does it make sense to have strict rules about multiples? NFM's earnings went up 14x over the following 10 years.
I don't know. I've read two conflicting accounts of what happened with Nebraska Furniture Mart, and we don't have a lot of detail of the actual prices and stuff, so I just don't have a lot of confidence with that. I do not use earnings, to be honest. This is something I've said before. I really don't use PE. So I am willing to buy a company I think is trading at, I'm not going to pay more than about 13 times what I think its earning power is. And I'd really like to pay more like 10. I think people shouldn't buy more than about 15 times earnings power. But earnings power is not the same as earnings. So a company that has that normally earns a certain percentage on sales or something like that, but is not earning anything now is not a problem for me. I'd be happy to buy something in a bank in a year in which it takes all these provisions so that its earnings are zero, but they would be better in a normal period. So there is definitely a price that's too much to pay in terms of sales, and there may be one in terms of book. There is not one in terms of earnings because the company could double or whatever its earnings. You know, Cap Cities was able to take over properties that had 30% EBITDA margins and bring them to 50. If you look at some of the things we buy and stuff, it's a belief that earnings will rise faster than sales. So, but I think our purchases are reasonable on the basis of price to sales or price to book or something like that. But it is true that we will sometimes pay a higher PE than other people are comfortable with. But that's because I have reason to believe that earnings will go up without capital being increased.
When buying a basket of net nets, would you screen for quality, low leverage, etc., or just buy the basket? Also, does Geoff ever get excited, or is he an android? Of course he gets excited. What kind of question is that? He gets excited when he sees me. He said, I got an 8. Remember that? I'm asking, how much did you miss me? I got an 8. He gets excited when he sees me.
I personally would screen for those things for quality and stuff. I mean, not screen, but I would look into it to make sure it's a legitimate business and stuff myself. There's no proof that helps. Backtests show that some of the junkiest net nets seem to do fine. I don't know if I believe those backtests and stuff. I follow the kind of approach of buying the kind of net nets that Buffett and Graham and stuff would buy. That's not exactly what academics say you should buy. And some of the best net nets will, of course, come back from being nearly dead and stuff. And so backtests show that just buying any net nets, including complete garbage, works out very well. I don't know people in practice who have had the stomach for that, but if you can do it, then it should work. But I also think it's kind of silly to talk about it because both methods outperform the market. So any method that any pure net diet you're willing to stick to is going to probably outperform the market in the very long term, unless you do adverse selection stuff where you actually pick things that are especially poor net nets to pick. So I think as long as you're sticking to just like common sense, you might add to it. You won't detract a lot from it, and net nets in general tend to outperform the market in the very long term.
What gets you excited?
What gets me excited?
He's asking if you ever get excited.
No, this is about it.
Geoff gets excited. Geoff gets excited when we go on trips, when we visit companies and talk about stocks. You know how I could always tell when you're about to get into it? You start rubbing your hands together and you're like, and I'm like, oh, he's in the zone right now. We've been in a couple of meetings, even with investors, and you rub your hands together. I'm like, oh, he's feeling it. He's going. Okay. Potentially stupid question, but after Googling, I'm so confused. Common stock on Quick FF's balance sheet is always less than shares outstanding on the same stock on Bloomberg, which matches weighted average shares outstanding in a 10K. Can you explain terms? Dumb question. ?
No, I'm not sure I can explain the difference of that. So the weighted average shares outstanding is an average of the entire time period. So it shouldn't always be happening, but if the share count is falling during the quarter, then it would matter. It also might depend on how they calculate dilution. I actually just use the front page of the 10K normally, unless there's reasons for us to use other things, which gives you the most updated number of the actual shares outstanding as of the time you're working with it. However, in the reported earnings and stuff, they are going to actually use the average, meaning between the time that the quarter started and the quarter ended, which means if the share count's been falling or rising, it will be different than the share count outstanding now. I think the share count outstanding as of today is the number that matters more.
Mm-hmm. Yep. Thoughts on dark stocks that don't communicate with shareholders?
Well, if they really don't communicate with shareholders, we can't own them. I mean, just because I don't know how to do that. But it has been our experience that they're dark. So allegedly dark stocks that you just call them up, or you just email them and they say, here's our annual report. We're happy to give it to you. There are ones that are like actually dark or that make you sign NDAs or something. But I mean, we'll just give an example. We're right. I don't think it's a problem. We just emailed Beaver Coal and asked for past annual reports and stuff, and they gave us a few annual reports.
Like what, 5 years, 6 years?
And like,
something
right,
like
they were instantly.
Right away.
I mean, they were more responsive than a Fortune 500 IR site would be. Mm-hmm. So there's a person there who does investor relations. They have a website and stuff. It is true that they don't put it up on the website. So yeah, we could do in theory a banker and insurer because of the regulatory thing, unless they were doing something kind of slimy or something where there was a difference between the holding company and the bank or the insurer that they owned, you can get regulatory stuff on that. But other than a bank insurer, I don't see how you could do it without information from management. Once you're a shareholder, they kind of have to give you the information. Now, they can certainly outlast you if they want to make a legal issue of it or something, even if it's frivolous. Yeah. So there are a couple companies that will do that, though. So there are a couple that are actually dark and protecting it, and I would avoid those.
Next question. He's asking for a snap judgment on PLNT as a short. Is that Peloton?
Oh.
Or is that Planet Fitness? I don't know. Yeah, it's Planet Fitness. Okay.
Planet Fitness. Why don't you talk about it? I don't know. This is not a business I understand.
I don't. I've never looked into it. I've never even been to a Planet Fitness. Actually, no, that's a lie. I have been to a Planet Fitness one time.
Okay. How'd you like?
It was. They serve. What do I have to say? They serve like bagels and pizza and on like Wednesdays or something. That's like the weirdest concept of my life.
Oh,
no. I don't know. We don't tons of operating leverage. We would never. I don't think we'd ever be interested in.
There's a Planet Fitness not far from here. I invested in a gym thing one time. It
Lifetime Fitness, right?
Oh, so I wrote up two things: Lifetime Fitness and Town Sports. Yeah.
Okay.
Town Sports is known. Maybe if you ever see it written up or stuff, it's almost certainly by some people who live in New York, because it has a chain in New York and stuff, and that's where some investors tend to live. So that's why it's a little bit better known.
EV to sales 9.5. That's expensive.
That's hard to believe. But is that a lease thing that's why that's so high? I don't know the details there.
I would have no opinion on this company though.
Okay.
I don't even like the chain.
All right.
So, let's see. He says our snap thoughts on in general in the current climate in the near future. Well, I mean, Gold's Gym is going through issues, right?
Yeah.
Because of COVID and everything.
I don't know. I mean, it's not an industry that I like all that much. I think to some extent they do benefit from people it's not like movie theaters or something. They do benefit from people who continue to pay even though they can't get use of it or use in the way that they did before. And it depends on what their landlords are like. In terms of giving them leeway there with the expectation they'll be okay in the long run. But it's not an area I know a lot about and not one I like that much. Lifetime Fitness, of the businesses there, it's not public anymore. But I have to say it is the one I liked best in the way that it was run.
Didn't Mick McGuire take that company, help that company get sold or something like that?
He definitely owned it.
He was an activist
the
there,
real
right?
estate was significantly valuable.
Yeah.
So they would buy up big parcels of land. They even here in Plano or Frisco or wherever, they own that land that it's sited on, and it's quite valuable land. So they were under leveraged compared to lots of other businesses. The land was actually probably more valuable than it was held on the books for. And they just do better about actually retaining people who are active and stuff. Now they try to cross-sell them on all sorts of things to get them to spend more and more per person, but they're certainly more satisfied in general than some other things. Like Town Sports in New York and stuff has a very, frankly, dissatisfied base of people using it and stuff. It's just that there's not a lot of choices sometimes really close to their work and their homes and stuff, especially their apartments, especially in places like Manhattan. It's just hard to lease those places.
Is free cash flow to enterprise value generally the best valuation method to value a company?
Yeah,
I would say so.
If it's normalized free cash flow, I mean, that's the thing that matters is the actual, what they say free cash flow isn't what matters. I think studies have shown there's not much difference between that and like EV to EBITDA or EV to EBIT, but.
Why don't you guys do financial modeling and use DCF analysis for valuation?
I mean, that would sort of make the most sense for a business we knew nothing about, but I don't want to invest in a business we know nothing about. And then I think that the answer that it gives isn't going to be that helpful. But it's true that if we were blinded to any outside information or any analysis of the business or whatever, that is the theoretically correct way of doing it. If you want a computer to calculate what the value of stocks should be, if no one can know any information about stocks except for their financial statements, I guess that's the way that you would do it.
We have done DCFs before, though. Remember when we looked at Howard Hughes Corporation, 4 years ago?
And I talked about it with reserves of companies that you should do a DCF for them. So like mineral reserves that would last a long period of time and stuff. What's the value of them? It depends on the DCF. Howard Hughes, they were going to sell it off over time. We could never assume that they would sell it all at once. The DCF might be a perfectly valid way of looking at Maui land and pineapple.
I just feel like it doesn't need to be that complicated. Yes, we look at the financials. We pull reports. We very much look at the margins. We take the coefficient variation, the mean, median. We do all this stuff on the financials. I just think like, no, we're not running like an LBO on the company to value, or you know what I'm saying?
Yeah, I mean,
I just don't think it has to be that hard, like back of the envelope or nothing.
Yeah, I don't understand. I don't think DCF has ever been proven as a useful technique for investing in stocks. Most people it's widely used by people, and it seems to be less widely used by people who are successful than people in general. So,
how so?
Well, if you take the 20 best investors, how much do they rely on DCFs? If you take the 20 business,
well, I mean, a lot of them may use DCFs, though. Like, for example, they may say like it's trading at this PE or this forward PE. I mean, what's going into that? It's effectively a DCF, right?
I don't disagree with it as a theoretical statement about what should be used, but the idea that you could apply it is the problem that makes is the part of it that doesn't make sense to me.
I just think we always get a lot of questions on this, and obviously valuation is very important, but I just don't think it. I think people, they spend a lot more time thinking about this than they should about the business.
I don't think that you should be doing DCFs, personally.
What are the best overlooked industries? A lot of the companies we invest in are very niche. Like, you say
right.
niche or niche?
Niche, I guess, yeah. So what are some of the best? Well, I don't know if they're overlooked, that are like smaller industries or whatever. So, I mean, we invested, we don't own the stock now, but we invest in computer services. I believe that basically the 4 biggest companies in the core processing industry left have all been 100 baggers or so since public companies. It's certainly been very successful, outperformed. I occasionally mention things like lime industry and stuff, things in that category of lime and cement and gravel and all sorts of things you can't move very far, I think can be things that people never look at. People always talk about the globally traded commodities. I would say look at the commodities that you can't move that far. Even something like when we do NACO and stuff and lignite, that's lignite versus metallurgical coal and stuff. I think that stuff that has local things, I think, are another one. So, but the best ones generally are the ones where there's a good company or many good companies in it, but there's not multiple publicly traded companies in it. So, like the reason why everyone ignores Tandy Leather or something is because there's no other leather crafting ones in it.
Cool. I think that's a good place to stop. We are going to be doing a part 2 of all these questions, and that will go up the following week. So definitely be on the lookout for that. I want to thank everybody so much for tuning in with Geoff and myself. If you are watching us on YouTube, hit the subscribe button, thumbs this video up. If you're listening on the podcast side of things, a rating, review, but most importantly now, the subscribe button goes further than a rating review. And we would be very thankful if you did that. Thank everybody so much for tuning in. Thanks so much for all the support. This is a lot of fun for Geoff and myself. It wouldn't be fun if nobody listened. And of course that, just makes everything that we're doing here really interesting, and we're all learning, and we really appreciate it. And we will see you in the next podcast.